Thanks for clicking. Canada's Menacing Mortgage Math means that the Bank of Canada is going to have to cut rates aggressively in order to prevent a meltdown in the real estate market and the economy. This according to a report from Dale and Smith of Rosenberg Research.
I won't be needing this.
And this isn't the first time that we've heard this, with Desjardins recently making headlines by saying the bank will have to cut rates in order to save mortgage renewals. CIBC's Benjamin Tell saying that if the bank doesn't cut rates, it's not going to be pretty, arguing that the bank will have to cut to save the COVID cohort. Yet, the report from Rosenberg Research takes this line of argument, which is focused almost solely on the real estate market, and looks at the actual data, trying to uncover what the economy will look like if the Bank of Canada doesn't cut rates in time for these renewals. Given that the government is currently stating that it's looking for ways to make real estate more affordable, and that rate cuts, all things being equal, are likely to send prices surging back upwards again, the Bank of Canada has certainly found itself between a rock and a hard place. So what I want to do today is go over the report from Rosenberg Research, taking a look at the specific numbers on what happens to the economy if we don't get those substantial rate cuts, look at implications for the real estate market, and then discuss whether or not the bank will be in a position to cut rates in time. Speaking of cutting in time, we have a big week ahead of us with StatsCan set to release October CPI data next Tuesday, and we'll obviously have an update out on that data on this channel. Click like and subscribe if you want to get those updates, but for now, let's get into this report. Onto the report. The report starts by noting that Canada has over $1 trillion in mortgages renewing by 2026, all of which will be renewing at higher rates unless we see substantial rate cuts coming from the Bank of Canada. And we've definitely heard this before, with a note coming from RBC just a few weeks ago, noting that renewal payments could be as high as 84% by 2026 if rates aren't cut.
I want you to understand that I am looking out for you in this thing, okay?
However, as mentioned, the report from Rosenberg follows the math to take a look how this would affect the overall economy. The report notes that it's accessing data from the Financial Stability Review and CMHC. Now, as a brief aside, from what I can tell, there's no such thing as a Financial Stability Review in Canada, and, of course, being an article on real estate and the economy, the authors don't cite their sources. Did any of these experts ever attend school?
I'm self-smarted, basically, by myself.
So, I can only assume that the report is talking about the Financial System Review, which was published by the Bank of Canada in May of this year, and showed the increasing number of mortgage renewals coming due over the next 3 years. Regardless, in assessing the data, the report says that the real problem with Canada's mortgage market comes in 2026, with about half of that $1 trillion coming due over the next 2 years, and the other half, about $500 billion, coming due in 2026 alone. The report says that although the average mortgage payment in Canada in February of 2022 was $1,460, it's now sitting at $1,900, a nearly 30% increase. However, says the report, that number is set to increase by 15% by the end of 2024, by 30% by the end of 2025, and by 45% by the end of 2026. Now, on to the important part. These larger mortgage payment increases will lead to a 20% reduction in disposable income, meaning a 20% reduction in the amount of money out there floating around in the economy, a 20% reduction in the amount of money out there spending. Now, of course, this is all things being equal, and even the report notes that all things are not equal. Some households will make extra mortgage payments, and some will downsize to reduce their mortgage burdens. But still, a 20% reduction in the amount of money being spent in the economy will no doubt have a big impact. And of course, says the report, some households will default if mortgage rates stay high. And this point is well taken, as even Canada's banking regulator, OSFI, has instructed our mortgage insurers to put aside more money in case of the pending defaults. And given the amount of money set to leave the economy in 2024, 5, and 6, the report argues that the Bank of Canada is going to have to switch its posture and relatively soon, with the report predicting rate cuts by mid-2024.
It could be days, weeks.
So, all in all, whereas the majority of the reports that we've seen, that we've reported on this channel, say that the Bank of Canada will have to cut rates in order to save real estate, this report takes it one step further, saying that if real estate doesn't get saved, it will take the economy with it.
In other words,
So, if this report is correct, will the Bank of Canada be in a position to cut rates by mid-2024 in order to save the economy for 2025 and 2026? Bank of Canada Governor Tiff Macklem recently said that if the bank sees core inflation coming down in a meaningful way, then the bank can cut rates ahead of hitting that 2% target. Over the past 3 months, core median is up 0.87 and core trim is up 0.94, or annualized at 2.62 and 2.81 respectively. So if this keeps up by June of next year, we should be in decent shape. However, when we annualized core measures of inflation at this point in time last year, it looked like we were heading for a core CPI of 3%, not much higher than the forecast right now, and, as we saw, core inflation ended up accelerating. So, it's not abundantly clear, as of right now, that core inflation is going to head down as fast as it would need to in order for the bank to justify rate cuts by June of 2024. And, make no mistake, the bank would indeed have to justify any rate cuts, unless they want a visit from the bond vigilantes.
You get a dictionary.
The good news, depending on how you look at it, is the report from Rosenberg Research is correct. For every month that passes, for every mortgage that renews at a higher rate, more and more money is being pulled out of the economy. More and more pressure is being relieved off of the CPI.
Thank you.
The bad news, again, depending on how you look at it, is that, even the report admits, the US is going to stay with higher rates for much longer than Canada. And, as such, there is going to be strong downward pressure put on Canada's loonie, which will also push inflation back up. So, all in all, I don't think these numbers lie. Canada is set for major renewal problems coming up in 2024 and especially in 2025 and 2026, if they can't get rates back down by then. With that said, the problem that we've been talking about since the beginning of the rate hikes continues to remain. Can the bank get the inflation rate back down to 2% before it has to cut rates, before the rate hikes cause a deep recession? And all of this isn't even to mention that the Bank of Canada only controls short-term rates. They really only control the variable rate mortgages. The bond markets come 24, 25, and 26, and all the pressure being put on them will be the deciders of fixed rates. With that said, we will continue to track Canada's inflation rate and the Bank of Canada's attempts to get it under control on this channel. Click like and subscribe for any of those updates, but for now, thanks so much for watching.